So I'm Dino Bokouris. I'm the speaker today, founder and managing director of Momentum Cyber. We are a cybersecurity-focused advisory firm. So what we do with companies is we help them with capital raise support, we help with M&A, we work both on the sell side and buy side, so large strategics sometimes hire us and to help them scour the universe for crown jewels of cyber companies that they could potentially invest in, acquire, partner. So just kind of think of us as super connectors in the cyberspace and supporting kind of transactions of all shapes and sizes. So enough of the commercial. For those of you that maybe haven't heard of us, you may have seen this before. So we have the wonderful task of maintaining and updating this document. People often tease us because they joke around about how small the logos are and how big the page has to be. This is actually only 1/4 of the companies that we track. So it's really just a representation of the industry, and there's maybe about 1,000 unique logos that are on that page. But just gives you an idea of how stiff the competition is in this market, which I'm sure all of you know in this room very well. So we'll dive in. Before we get to the fun stuff, which typically is the predictions and what to expect going forward, we got to take a quick snapshot and look back at the year behind us. Now, obviously, 2022, I'm not going to go down the path of the headlines. A lot of those were really doom and gloom headlines. But when you just take a step back and you look at the year as a whole, how good was that year? The one thing I tell people is that when you look at 2022 relative to 2021, it's a little bit tough. 2021, I consider kind of the sugar high of strategic activity in the space. But when you look at 2022 on its own, it would have been a record-setting year if it wasn't for the activity that we saw in the year prior. What I mean by that is we've had 13 deals that were north of $1 billion M&A. Obviously, VMware, SailPoint, Datto, all of those were kind of the headlines, but strategic activity was still relatively healthy. We saw on financing, if you look at that area, we saw about a little over 1,000 deals last year. If you look at the year prior, it was actually about the same number of deals that occurred. So there was still a healthy clip of activity as it relates to financings. We saw private equity continues to be incredibly active in the space. About half the deals were attributed to private equity. Which is great, and we'll get into kind of what they used to do about a decade ago and kind of what that landscape looks like today. You also looked at the overall volume of activity. So the $120 billion on the M&A side is a little bit misleading. $70 billion of that is skewed by the Broadcom VMware deal. But even if you take that piece out, you'll see on the next slide, it's still relatively healthy compared to activity over the last decade. Also, when you look at this, capital raises, so there's 95 capital raises north of $50 million. When you look at the top 10 capital raises, which is what's shown on the slide, those actually, the smallest deal on the page looks like is $200 million. So there's still healthy, large rounds that were happening on the financing front. Much of that was skewed a bit towards the beginning of the year. Obviously, we saw a continued slowdown going into the end of the year. And really what was in the headlines was that top right bucket over there, right? What's happening in the public markets. The multiples in the public markets came down drastically. Some companies lost 85% of their value. So where you look at some of the leading players that were trading at almost 100x multiples, those have come down significantly, and some of which are even trading actually below 10x at this point in time. I thought one other interesting point for 2022 is usually we talk about IPOs. So how many new public cybersecurity companies did we create in a year? Last year, we actually went the opposite direction. So 8 companies were actually taken off the public markets, again, from the private equity activity that you see in the bottom left corner. But it was just really interesting to see the year where the number of public cybersecurity companies actually went down. Now, why am I not worried? So when you look at activity over the past year, you kind of see the blood sugar spike there in 2021 with all the capital that was chasing cyber. 2022, when you look at it relative to the past decade, was actually a pretty good year, both from the standpoint of M&A. It was almost 4 or 5x what we were seeing in activity a decade ago. And then also when you look at financing, it still would have been a record-setting year if you just kind of omit the 2021, which obviously had much more activity than probably any of us expected, especially when you were kind of going into the pandemic. Additionally, cybersecurity budgets are still what I would consider very healthy. You're looking at an industry that has double-digit growth and predicted growth going forward into the future. Obviously, the bad guys didn't get the memo. Recession or not, they're going to continue attacking, and we're going to continue having to defend ourselves. Now, there is a little bit of a nuance to this. So while the budget in 2023, and obviously these are just predictions, so I think the decimals are probably not something to pay attention to, but the budgets in 2023 are, from what we're hearing, ranges anywhere from 7 to, call it 12% budget increase. The compression we are seeing, however, even if it's a small amount of compression relative to the prior years, it's what I would consider discretionary budgets, kind of the innovation budgets. So a lot of the early stage startups, unfortunately, are feeling kind of a disproportionate amount of pain in the market. So I'm sure many of you in this room know that very well. When you're going in and you're trying to get the attention of folks, if you're not a must-have technology or let's call it a should-have technology that is on the priority list of the folks that you're selling to, 2023 is going to be a tough year to make sales. That discretionary budget piece, even with cybersecurity being one of the most defensible budgets out there, I'd say cyber and cloud spend are probably the two most defensible budgets that we see in enterprises. You're still facing a lot of pressure if you kind of fall into that innovation or discretionary category. If you're kind of a tried and true solution or one of the core capabilities that they need, even for upsells, I mean that's no problem at all. But unfortunately, that discretionary piece hurts most of the innovative and kind of the up-and-coming startups, which is unfortunate because obviously cyber is an industry that, as per my comments on the Cyberscape, it's just an industry that has many, many folks that are trying to, reinvent certain sectors and really come up with solutions to keep up with the ever-changing threat landscape. Actually missed one point here. So, and then when you look at the right-hand side, the reason I really added this piece in there is that bar you see on security services. So we'll get into kind of what were the areas of, investments going forward here in a couple of slides. But security services have been and continue to be the #1 sector that we see capital flowing into, and it's also understandably so. When you look at security spend, it's also a disproportionately high amount of the spend that we're seeing comes in the form of services. That could be MDR, MSSPs, managed identity, professional services, red team, blue team. I mean, it could be a wide range of services, but one thing to just note is that's a trend we're seeing on the spend side, and then we'll get into kind of the invested capital side as well. So another reason that I'm not worried, especially as it relates to financings, so when you look at the amount of dry powder that's available in the U.S., most of you probably already know what that means, just for anyone who doesn't. So really it's just the amount of capital that is basically available for investors to deploy. So they have certain amounts of capital that get committed to them by their LPs, and it's, as you can see, it had reached a record high in 2022. And that number continues to climb. We're hearing, and some information isn't public yet, but we're hearing about billion-dollar-plus cybersecurity-focused funds that are being raised as we speak. And when you look at the amount of capital that Q3 of last year, there was over $300 billion of capital in the U.S. only that was still available and ready to deploy. Now, if you understand venture capital and private equity models, the way that works is, that capital gets committed. You actually, as a VC or PE firm, you start clipping management fees off of that total number, and your LPs are paying you those management fees to put their money to work. So what we saw is that slowdown that may have happened with activity in the kind of the tail end of last year and beginning of this year. That slowdown can't last forever because they don't want you basically taking management fees just to have their money sitting on the sidelines. So there's a pressure on the investors to get deals done, and I feel like maybe there's a couple more quarters where they can afford to actually wait, but they can't do this indefinitely. They have to start putting money to work. So I think there's a natural force kind of going into the space. I mean, similarly, when you think about it from the company side, the founder side, there's also a natural pressure because, of course, most of the companies are burning capital. Some of them kicked the can down the road. They got a bit creative, if you will, on the capital needs of the business. So they tapped into debt, they tapped into safes, they tapped into kind of anything that allowed them to bring money into the company without having to draw a line in the sand and say, this is what our valuation is. Because the big challenge, as you all know, that we saw, call it, 3-4 quarters ago, is when the valuations in the public markets collapsed. The private markets still, I'd say founders still had this in their mind. Well, companies were trading at 30, 40 times revenue, a month ago. That's still what I'm worth today. But when they went into the investors' offices, the investors tried to leverage the public markets information to basically say they were worth half of that. So that disconnect and that bid-ask spread for valuations for these businesses, so that kind of creates a bit of pressure. So there is obviously a need for the companies to continue raising money because you can't just keep raising debt and safe notes and other creative instruments forever. That's really only a temporary stopgap, if you will. And then when you look at where the money is flowing, so we already talked about how the cybersecurity budgets, disproportionate amount of that is really going into the security services space. May not be a surprise that when you look at M&A, security consulting and MSSP is the number 1 and 2 categories for kind of number of deals and kind of across the sectors. Obviously, risk and compliance is kind of a close third, and then we're seeing identity and so on down in the market. But I would say the most telling piece that I see, and shouldn't be a surprise, I mean, we have the cyber talent shortage. We have folks that want to effectively outsource this, whether it's from a liability perspective where they want to transfer some of that risk onto others. Maybe they use cyber insurance. Oftentimes they really just want to have people come in and take care of the problem, right? It's more of a solution-oriented approach where it's not that I want to buy my 89th product in my security stack, but rather, can you just handle this outcome for me? And it's less important about the tools that they're using, but it's just more important about what is the outcome that they're committing to. And that's why we see a lot of this activity here. And then when you look at financing activity, this one's a little bit different. There's probably 2 forces at work. One, it's more in line with where we see innovation happening in the market. Probably no surprise, you're seeing data security there. So a lot of the DSPM and DDR companies that are out there, raising capital, contribute to this stat. But also, some people say, well, why isn't security services, one of the top, 1, 2, or 3 categories there? We often find the services companies don't necessarily need to raise as much capital as others. Now, Arctic Wolf and Expel and Deepwatch and others, they'll prove that point wrong, and they're obviously trying to look and feel and smell more like product companies than they are services companies. But when you look at professional services, when you look at companies that have a reseller component, a lot of times those are actually profitable businesses, or they're reinvesting their profits and they're break even. So they're not typically the ones that you see that are going to get the kind of the earlier stage venture investments in private equity. They typically end up getting those investments a little bit later in their life cycle, and as such, a lot of times it comes in the form of M&A or majority recaps. So you don't tend to see a ton of VC activity in the security services space. So when you look at private equity by the numbers, I mean, the takeaway here is really about a little over a decade ago, they accounted for about 15% of the deals. And at that time, it really felt more like, buyer of last resort, if you will. Today, that's just not the case. Private equity accounts for almost half of the activity. It's going to be, PE directly or PE-backed companies that are snapping up other assets and acquiring businesses. And there's many, many more firms that are out there that are actually focused on cyber. This is just a sampling that you see in the bottom right. But we're seeing a tremendous amount of activity. Obviously, Thoma Bravo seems to be buying the world. But there's many more investors that I would say are very cyber savvy, really understand the market. They're not just kind of venture tourists, if you will, dipping their toe into cyber. I mean, they're all in with teams dedicated to cyber and really helping fuel a lot of that activity in the space. So this slide, I usually have a quiz, but I know it's still morning, so I won't go there. This slide sometimes surprises people. They usually expect to see, when you talk about who are the most active acquirers over the last 8 quarters. Most people are thinking, oh, it's going to be Palo Alto or Cisco or CrowdStrike. Surprisingly, you see Deloitte and Accenture up top. Now, some of you might be thinking, well, if security services and MSSP is the number 1 and 2 category in M&A, probably makes sense that you see service providers kind of heading up that list. There's obviously some companies on here that some of you probably maybe have never come across. You see, cybersecurity companies, you see the public infrastructure companies, Microsoft and others, MasterCard, 3 cyber acquisitions over the last 8 months, not bad for a company that's focused on credit cards. OpenText and Cisco, obviously those are some of the usual suspects, as you call them. But really the takeaway here is that it's more than just the public cyber companies that are buying. Now when you look at public cyber companies, that is also a stat that, I know I talked about earlier how in 2022 we saw many of those come off the public markets and go into the hands of private equity, but it's still, we're call it 3x where we were a decade ago in terms of kind of public pure play cyber codes that are out there. And then when you look at, market capitalization, that's, almost a 5x growth that we've seen. So still incredibly healthy market, even in the public markets, even with all these take privates. And it's a trend that we hope kind of opens back up. Probably not going to happen this year. Maybe 2024 is probably going to be the year where you start to see cybersecurity IPOs again. Barring any other bankings imploding or any other shocks to the system, but still it's a large opportunity even for the pure play cyber companies out there. On the next slide, I get this question. I'd say number one question is, what's my company worth? So this is just one kind of angle that we take when you're valuing a business. It's not, not every company is really can be compared to some other business that's in the public markets. But this is kind of one factor that we use is really look at where the public markets are trading. Now, when you get into the earlier stages, if you're a seed, Series A, Series B company, and you're trying to, price your round, let's say, and you're raising capital, some of this kind of, the science goes out the window, and then art actually enters the equation. And it's a little bit trickier to try to zero in just simply as a multiple of revenue, for example. A lot of times, investors are betting on the team, the vision, the market you're going after. There might be some intangible, assets that you have that are not able to be valued as a multiple of your sales. For example, if you look at companies that have really strong developer communities, they tend to get valued based on the size of those developer communities and the relationships they've built there, and not so much on the sales. Obviously, Snyk is the obvious one there, where when you start to see, even in the early days in particular, when you start to see their valuations really creep up as their revenue wasn't very high, it's that relationship they built with the developers that investors were rewarding. Now, when you look at the data on the page, the takeaway here is that even when you start to look at the last 12 months, which, yes, that data point from 12 months ago is actually during, I would say, the crash that we saw in the market. So it's not as drastic of a step down, but effectively what the data is showing here is that our median multiple is about a 5x. And what that really means is when you're a company that's trying to justify that you're worth 20x or 30x when you're talking about M&A, and there's some really high quality assets that are trading at call it 10x or even below 10x for companies like CrowdStrike and Zscaler and others that are doing a tremendous job growing the business, high net retention, and a lot of those statistics that are up and to the right. It's hard to justify that, well, if investors can put their money in those companies at a 10x multiple, how do you go into the room and actually justify the 20, 30x, 40x multiples? And that's why I'm saying the art enters the equation as opposed to really a scientific or formulaic approach to understanding what your business is worth. And then when you look at kind of how companies get valued the way that they're valued, probably no surprise, this trend has been occurring for at least the last year and a half. When you kind of look at that R squared in the corner, and I know there's probably statisticians in the room here that are gonna try to debate the utility of that, especially when you're talking about an R squared of call it 25%. The real takeaway here is just when you look at value as it's correlated to growth. Historically, we've seen that number as high as, call it 70, 75%, 80%, where you're seeing a pretty distinct kind of correlation between how quickly a company is growing versus how they're rewarded in terms of the valuation, in terms of that revenue multiple or the value of their business kind of as a ratio of the amount of sales that they're generating. And that correlation is pretty weak today. So it's not necessarily what investors are valuing businesses on. So that's one takeaway is that growth at all costs is no longer being rewarded, and it's really a measured, balanced approach to growth that folks are looking for today. Now what are investors looking for if it's not just growth? So these are just some of the metrics, and I figured this could be a useful slide for folks because it's probably the number 2 question we get asked after they realize that it's not just a multiple of what's my business worth, but really what are investors looking for? What are the public markets looking for? Some of these are obvious, and you've come across many times. Others might be a little bit newer, but really things like gross margin is an obvious one when you're selling your product or service. How much does it actually cost you to deliver that product or service, and kind of what is that ratio and what does that look like? So we won't go through kind of the full range here in the interest of time. But you see things like LTV to customer acquisition cost, that second ratio. It's really just saying what is a customer worth to you in your business, and how much does it cost you to get that customer? Now you can look up the calculations and formulas behind this, but it's effectively saying how efficient is your sales engine. And you'll see this number kind of shift drastically. We've seen businesses that have a ratio of 1. We've seen businesses that have a ratio of 7, 8, 9 if they're kind of best in class. Burn multiple. So really what that is, it's when you look at how much capital you burned over a period of time relative to how much ARR or revenue did you add to that business. So if you burned $5 million last quarter, but you also added $5 million of kind of net new ARR to your business, that's your burn multiple of 1 that you would see on the screen. So obviously, it ranges. I'd say if you're at 1 or above, you really are best in class. I mean, it's hard to find companies that are, I should say, 1 or below. It's hard to find companies that are actually below 1 as it relates to a burn multiple. That means it's a very, very efficient business. But that's kind of, when you look at the business as a whole, it doesn't just focus on sales and marketing. Magic number is another one that you'll see and investors will care about. The short way of kind of describing what that is, when you kind of look at how much you did in sales, let's say last quarter versus this quarter, what that delta is, and how does that relate relative to the amount of money that you spent in sales and marketing last quarter. So again, it's kind of like a sales efficiency metric that lets you know, when your magic number is less than 0.5, you should probably kind of optimize and re-engineer some elements of your sales machine. Just throwing more money at the sales machine, if it's not an efficient, well-oiled machine, may not be the best use of funds. So that's really a number that lets you know kind of how efficient is that machine, and should I continue to invest in it. If you have a magic number, you're kind of north of 1, 1.25, keep putting money into that machine, because you can predictably expect or predict the result that comes out of the back end when you actually insert a quarter up top. What's going to actually come out of the bottom of that sales engine that you have. Gross retention, I'm sure you all know what that is. It's effectively looking at a business and the amount of revenue that you're generating from a certain set of customers at the end of that period. Usually it's a 12-month look back. How much of that revenue still remains? So how much of it did you lose, and how much of that remains? That doesn't include things like upsell. When you start including things like upsell, you get into the next statistic, which is net retention. And that is another area that, if I would say what's probably the most important thing next to, there's growth, there's gross margin, really it's your retention statistics. It's probably the next most important stat that folks are going to look at, because that just kind of tells people how what is the expectation, or how predictable is your revenue of your current customer base, so that you can kind of understand what it is that you need to bring in as kind of net new revenue from new customers. And the last piece, we talked about ARR growth. People always say, well, what's a good number for growth? It's really not a simple answer. If you're a business that's growing 10%, but you're actually highly profitable, that's actually more in style today than if you're a hyper-growth business growing at 80%, but you're burning a ton of cash. So it's kind of a balance between growth and profitability. I'm sure a lot of you have heard the phrase kind of rule of 40. So when you look at kind of the percentage of growth that companies are seeing year over year, and you look at how much they're burning kind of as a percentage of the sales that they're generating for that year period, when you add those two numbers together, if you're above 40, it's kind of a rough way for investors to quickly say, okay, well, this is a business that's already fairly optimized in terms of kind of that balance between growth and profitability. But if you're growing 50%, but you're burning 100% of your revenue, so you're a $50 million revenue business, but you're burning $50 million a year, that's a problem, because when you look at those two added together, your growth effectively cancels out your burn, and you're a rule of zero company, which is not a place that you want to be. And then last slide before I open it up for questions, assuming we have some time left, is really kind of what are the key themes for 23 and beyond. Much of this I feel like I weaved into the discussion here as we've been talking, but when you look at a couple trends, so valuations. So valuations are stabilizing. Kind of that gap in that delta, that gap in delta between kind of the bid ask between investors and what founders are actually willing to accept. That gap is getting smaller and smaller, which is good because it's that gap that kind of caused a lot of the delays and a lot of investors sitting on the sidelines, right? They didn't want to overpay for assets, and the founders didn't want to sell themselves short and feel like they sold at too low of a price. And luckily we're seeing that stabilize. Obviously, there's still shocks that are occurring to the system. SVB was a big one for all of us. We're seeing First Republic kind of going through some troubles as well. So there are shocks that are kind of hitting the system, and people are just waiting to see what those ripple effects are. And the public market's going to go down even further. Obviously, there's a bunch of earnings calls this week with hopefully companies continue to beat their earnings, which easier to do when you just went through mass rounds of layoffs, I would say. But the bright side is that we do see that bid-ask spread getting shorter, and the pressure we talked about earlier from the amount of dry powder that's available on the sidelines, that's also kind of driving more activity as we go forward. So hopeful that in the next couple of quarters, kind of the ice will finally melt, and we kind of see some of that activity pick back up again. Again, absent any other kind of unpredictable shocks to the system that may or may not happen. Cyber spend, we kind of already talked about this point, but healthy budgets for 2023, discretionary is under pressure. We kind of expect that to continue in the future. I mean, when you look at healthcare, you look at defense, you look at cybersecurity. I mean, all of those are industries that you really can't afford to stop spending because the problem isn't going to go away, and it isn't going to follow any pattern of economic recessions. I mean, the need for the services don't actually shift with the economy. So fortunately or unfortunately, however you want to look at it, we have to keep spending in these areas. Some of those dollars may shift. They may go more towards services and more people focus on outsourcing. We are seeing, and we'll get to the kind of the bottom theme of consolidation, but we are seeing folks that are more interested in solutions that just makes their lives easier. Like, don't tell me more things. Don't tell me about more problems that I have. I want you to actually help me solve problems. And really that trend, it really, unfortunately, it can't go anywhere. I mean, everyone always talks about the cyber talent shortage. It's a real problem. It's, it's out there. Some people would say it's getting worse. And there's not many other solutions when you don't have the team to actually take care of it other than outsourcing the problem to others. So that cyber spend, in particular, the services spend, it seems like it has to keep growing and going up and to the right. Fortunately, the budgets, and we talked about this a little bit, the budgets in cybersecurity are relatively defensible relative to some other budgets in the organization. Obviously, cloud spend, you probably have a pretty good shot of getting what you need and getting what you asked for. The one thing that we are seeing is that the sales cycles are getting delayed and they're getting extended. Because normally you might go into the conversation, you expect to talk to the chief security officer or somebody that's responsible for that function, and then suddenly the CFO has entered the chat, the CEO has entered the chat. Some companies are bringing their board to evaluate the type of spend that we see happening. So the scrutiny on these purchasing decisions, even if they're these highly defensible kind of core capabilities, the scrutiny is just increasing. It makes your lives harder because, again, the sales cycles are increasing, and it just the uncertainty of predictability of pipeline is something that we're hearing from many folks. It's just they're having a hard time predicting it because they have all of this data from, let's say, a year, 2 years, 3 years of behaviors in the past, and they're expecting deals to close in Q1, and they get pushed all the way out to Q3. Or they'll win the process. A lot of our clients say, hey, we won this really big deal. All we need now is to get the PO signed. And the PO won't be signed, let's say for 2 quarters. They're like, well, you won, but we need to find some budget for it. So that delay that we expect, or that we're seeing, unfortunately, we expect that to continue as long as budgets are continuing to be under scrutiny, which for the foreseeable future, 2023, likely into 2024. That's just a reality we're all going to have to live with and kind of weave into our expectations. And then the last point on here is consolidation. So we're seeing consolidation at a couple of levels. One, when you look at customer consolidation, the number of security tools people are using are actually going, the attempt is to go in the opposite direction and actually use fewer tools. Whether or not they're successful in those efforts is a different story. So kind of what we're seeing is that, that pendulum is swinging from kind of best of breed players back to that best of suite mentality. So it's really folks that are looking for fewer and not more capabilities. So if you're just adding yet another product to their stack, may not be as successful as getting the CISO to open their wallet versus if you're removing some products from their stack. Obviously, if you're cost saving, that's another new, I wouldn't say new, but that's another area that we're seeing a renewed focus on is it's not just security solutions, but if there's a cost element, whether it's a force multiplier that makes their operations more efficient, whether it consolidates products because capabilities are already kind of brought into a broader platform. But that notion of consolidation we're seeing at that customer level. And then understandably so, it's also happening at the channel, right? So when you look at the big channels out there, the big resellers, SIs, I mean, they're really slimming down their book and the number of products they recommend. I won't name names. We know one that went from about 125 products in their book down to about 70 products in their book. So they're cutting almost in half of what they're offering. Unfortunately, once again, the innovators and the earlier stage companies tend to suffer the most. No reseller is going to take Palo Alto Networks out of their book and just not offer it to their customers. But if you're a data security, posture management solution, and they had, let's say, 2 or 3 innovative companies in their books, chances are, 1 or 2 of those might be cut out of the catalog, and they might just stick with what they perceive to be as kind of the market leader in the space. And then lastly, strategic consolidation. So, this has been occurring. This will continue to occur. But it's really, strategics, private equity, and others are consolidating the platforms for us. Not always the case. Obviously, Toma has bought, I don't know how many now, 3, 4 identity companies, and we have yet to see them actually start, mashing the businesses together to see if they can, create a more efficient machine. But in general, I'd say it is a common theme where a lot of that strategic consolidation is also going to help us in this problem of just, too many security tools, too many platforms to try to integrate and kind of duct tape together and see if you can create a solution. So yes, I mean, overall, I'm still relatively bullish on the activity in the space. I'm incredibly bullish at the underlying industry. So that is what I had in store for you today. I'm going to pause here for a second and then open it up to questions. But if there are no questions, thank you all for coming and wish you all a great rest of your conference.